Welcome, listeners, to another deep dive into the evolving landscape of technology and finance. Today, we're unpacking a significant development from Amazon, which has announced it will eliminate 14,000 corporate jobs, about 4% of its white-collar workforce, as part of a broader push to streamline operations and redirect resources toward artificial intelligence, AI, and infrastructure. This move is not just a headline, it's a window into the seismic shifts happening across the tech sector. Let's break this down, explore the historical context, global implications, and what this means for investors and the economy. Amazon's efficiency drive, a multi-year reckoning. Amazon's latest layoffs are part of a multi-year efficiency drive that began in 2022, during which the company has already shed over 27,000 jobs. This round of cuts, targeting middle management and spanning units like video games, grocery, HR, communications, advertising, and devices, signals a ruthless focus on cost reduction. The company's HR chief has hinted at more cuts through 2026, with some estimates suggesting a total of 30,000 layoffs, potentially the largest in Amazon's history. At the heart of this strategy is a reallocation of resources toward high-growth areas like data centers, custom chips, and cloud infrastructure to compete in the hyperscaler wars against giants like Microsoft and Google. This isn't just about trimming fat. Amazon's CEO has openly stated that generative AI will reduce headcount needs, and internal documents reveal plans to automate 75% of operations by 2033, potentially avoiding 600,000 new warehouse hires. This is a stark reminder of how AI, while a boon for innovation and stock valuations, is reshaping labor markets in real time. Since 2022, Amazon's capital expenditure has soared, with projections of over $120 billion this year alone, to bolster its cloud computing arm, Amazon Web Services, AWS, in the race for AI dominance. Historical context: the tech sector's efficiency blueprint. Amazon isn't operating in a vacuum. Its actions echo a broader trend among the Magnificent Seven tech giants. Meta's year of efficiency in 2023, which slashed costs and boosted margins, has become an industry playbook. Google has cut 35% of small team managers in the past year, while Microsoft shed 15,000 roles this summer. These companies are pouring billions into AI infrastructure, think hyperscaler capex, while quietly acknowledging that fewer human workers are needed to sustain growth. Historically, tech booms have driven job creation, as seen during the dot-com era of the late 1990s. But today's AI revolution is different. It's a capital-intensive game that prioritizes automation over headcount. Looking back, the post-2008 recovery saw tech companies hoard cash and expand workforces aggressively. Now, with interest rates higher and economic uncertainty lingering, the focus has shifted to profitability and lean operations. This pivot mirrors the austerity measures of the early 2010s, but with a modern twist: AI as both the disruptor and the savior. Global and sector-specific impacts. Globally, Amazon's layoffs and automation push will reverberate beyond U.S. borders. The company's workforce spans continents, and cuts to corporate roles could dampen tech job markets in regions like Europe and India, where Amazon has significant operations. Moreover, the hyperscaler race, dominated by Amazon, Microsoft, and Google, has geopolitical stakes. Nations are vying for data center investments as digital sovereignty becomes a priority. But this also means fewer local jobs as automation scales. Sector-wise, cloud computing and AI are clear winners, with hyperscaler capex expected to keep climbing. However, retail, logistics, and traditional tech support roles face headwinds as automation accelerates. For smaller tech firms and startups, the pressure is on. Competing with giants like Amazon on AI infrastructure is a daunting task, potentially stifling innovation in less capitalized corners of the market. Meanwhile, the labor market faces a paradox: high demand for AI talent, but shrinking opportunities for mid-tier and operational roles. Investment and policy implications. For investors, Amazon's moves underscore a critical trend. Tech giants are prioritizing capex over buybacks and dividends, as seen in recent analyses of hyperscaler spending. This suggests near-term pressure on stock valuations if earnings don't match the massive investments in AI and cloud. However, long-term, companies that win the hyperscaler wars could dominate global markets, making Amazon and peers like Microsoft and Google compelling, albeit volatile, bets. Diversifying into AI-focused ETFs or semiconductor stocks tied to data center growth could offer a balanced approach. On policy front, governments must grapple with the labor displacement caused by AI. Retraining programs and incentives for human-centric industries could mitigate job losses, while antitrust scrutiny of hyperscaler dominance may intensify as these giants consolidate. Policymakers need to balance innovation with economic stability, a tightrope walk in an election-heavy 2024. Near-term catalysts to watch. Keep an eye on upcoming earnings from Amazon and Google. Analysts are questioning whether consensus estimates for hyperscaler capex are still too conservative, especially with deals like Microsoft's $250 billion compute agreement with OpenAI, signaling fierce competition. Any updates on Amazon's AWS growth or AI partnerships could move markets. Additionally, labor market data in the coming months will reveal the broader impact of tech layoffs, potentially influencing Federal Reserve rate decisions. Conclusion: navigating the AI era. Amazon's layoffs are a microcosm of a transformative era where AI is both a growth engine and a disruptor. For listeners, the takeaway is clear: adopt or risk obsolescence. Investors should focus on companies leading in AI infrastructure while hedging against short-term volatility. Workers in tech must upskill in areas like data science or cybersecurity to stay relevant. As we move forward, the tension between innovation and employment will define the next decade. Stay tuned for more insights as this story unfolds, and let's navigate this brave new world together.